Today, we are going to crack open the code that basically runs Silicon Valley. And it's not some business strategy you learn in a textbook. It's a single, really counterintuitive mathematical rule that dictates who gets funded, which companies just explode, and why our tech future looks the way it does. So let's start with a paradox, right? A central mystery that just seems to defy all business logic. Venture capital is an industry that pours billions upon billions of dollars into the most innovative, world-changing ideas you can imagine. And yet, if you just look at it from the surface, it looks like an absolutely spectacular failure.
So this is the core question, isn't it? I mean, just try to imagine any other industry where 7 out of 10 projects are just expected to completely fail or barely break even. It would be a total catastrophe. But in the world of venture capital, this is just business as usual. How is that even possible?
Well, the answer isn't in some clever management playbook or perfect market timing. It's in a fundamental law of mathematics. It's called the power law, and once you get your head around it, the entire high-risk, high-failure world of venture capital suddenly makes perfect, if kind of brutal sense.
Okay, to see this in action, let's look at some cold, hard data from Horsley Bridge. That's a firm with stakes in over 7,000 startups. So they crunched the numbers and found that just 5% of all their deals, a tiny, tiny elite fraction,
we're responsible for a staggering 60% of all the profits. Just let that sink in for a second. The vast majority of investments, almost irrelevant to the final bottom line. The entire game is about finding and funding that tiny 5%.
So how does this math actually work? Because it's completely different from the statistical models we use to understand most of the world around us. This is the math of extreme, totally unpredictable success. Most things in life follow what's called a normal distribution, the old bell curve. Think about something like human height. Most people cluster right around the average, and really extreme heights are incredibly rare. But venture capital, it follows a power law. And in this world, there is no meaningful average. Instead, all the outcomes are dominated by these wild, massive outliers that skew absolutely everything.
This table really breaks down the key differences for us. In a normal distribution, the mean, the average, is a pretty reliable predictor. But look here, in a power law, as you can see in that second column, the mean is just totally warped by a few huge winners. Now, check out the row for probability of extremes. In a normal world, it's basically 0. In a power law world, it's relatively high. And that, right there, is where all the action is.
And this brings us to the key concept, fat tails. You see that thick end of the power law graph? That represents that tiny number of companies like an Uber, an eBay, or a Google. They are the 1000x return events that are statistically almost impossible in a normal distribution, but they are the entire reason the venture capital industry even exists.
So if you're an investor and you know the world operates this way, you can't play by the normal rules. You have to build an entire strategy, a whole playbook, designed specifically to hunt for those fat tail outcomes. And really, no one has articulated this playbook better than Peter Thiel. This quote, it isn't just a clever soundbite, it's a direct application of power law thinking. Thiel is basically arguing that to get a power law return, you can't just be a little bit better than the competition. No, you have to create something so new and so much better that you have no competition at all. You have to build what he calls a creative monopoly. This slide shows the difference perfectly. Competitive businesses, like say most restaurants, are just fighting each other over slim margins. But creative monopolies, like Google and Search, they invent entirely new markets and capture all the value. And that's what generates the massive returns VCs need.
Okay, so here's the crucial point. VCs aren't just greedy, they're literally trapped by this math. To deliver a pretty standard 3x return to their own investors, the numbers get huge, and they get huge fast. I mean, look at a $2 billion fund. It needs to generate $32 billion in exit value from its companies just to be considered successful. This forces them to ignore good, solid businesses in favor of absolute moonshots.
And at the earliest stages, the math gets even more extreme. A seed investor isn't looking for a 2x or a 3x return. They need a 100x return. Why? Because a single 100x investment can pay back their entire fund, making up for all the other failures. It's a statistical necessity.
So how do they manage this? Well, it's a two-step dance. First, you diversify. You spread your bets. You invest in dozens of companies to maximize your chances of just one of them being a power law winner. Then, the second a winner starts to emerge, you concentrate ruthlessly. You pour all your follow-on capital into that single company to maximize that final return. You trim the weeds and water the flowers, so to speak.
Okay, so that's the investor side of the coin.
But what does this unforgiving mathematical law mean for the entrepreneurs? The founders who are actually building these companies? Well, for them, the reality is even more intense.
An investor has a portfolio of 50 bets. A founder has one. They can't diversify. They are all in on a single company that is now being forced to chase a power law outcome. Some have called this the pummel law because the pressure is just immense and the outcome is totally binary. You either win big or you've likely spent 10 years of your life pummeling yourself for very little financial gain.
And here, this is the price of that chase. This table shows you the life cycle of dilution. With every single round of funding you need to fuel that hypergrowth, the founder's ownership stake just shrinks and shrinks. You might start with 80%, but by the time you reach an IPO, it's often down to 15 or 25%. That's the direct cost of playing the power law game.
This brutal reality has, not surprisingly, led to an alternative model. Instead of chasing these mythical unicorns, some founders are now choosing to build zebras. Real companies, not mythological ones. As this table shows, zebras pretty much reject the VC path. They focus on sustainable profit, on collaboration and long-term resilience, rather than the blitzscaling that's required for a massive exit.
So to wrap this all up, this isn't just some theory for investors. The power law is the invisible force that is actively shaping the technology we use every single day and the very structure of our future economy.
And we see its effects everywhere today. The massive concentration of capital into AI, that reflects the belief that AI will produce the next generation of monopolies. The fact that companies are staying private for longer, and the rise of all these complex financial tools like continuation vehicles, which basically allow VCs to hold on to their winning companies for even longer, these are all just adaptations to the same fundamental law, the relentless hunt for the outlier.
Which leaves us with a final and pretty crucial question. Is this high-failure, winner-take-all model the only way to fund truly radical, world-changing innovation? Or is the power law actually a blueprint for a brutal future, one that concentrates wealth and power into the hands of just a few, while leaving a trail of failed companies and burnt-out founders in its wake?